Good morning. Good morning. How is everyone? Thanks for joining. We have the Later Life Summer Fair on Friday, the 19th of July. So just something for your diaries. It's 11 a.m. till 2 p.m. at the Newman Hall in Henleaze. We're busy finalising all our preparations. Amy's been really busy building up stall holders, entertainment. You'll get to meet lots of interesting people, resources and support groups for people in later life in the local community. So it was really well attended last year despite the weather. So hopefully this year we'll get some not quite so aggressive weather that we had. Like we had hurricanes and rain last year. So hopefully we'll get some nice sunshine and it'll be a really good day. So that's just a date for your diaries. Friday 19th July, 11 a.m. till 2 p.m. at Newman Hall in Henleaze. So it'd be great to see you there. We have also been doing a Welcome Wednesday. So we had a really great Welcome Wednesday last Wednesday, probably our best ever. It's a very informal gathering of anyone really in retirement, later life, who's just looking for kind of a really friendly social group. It's probably the best attended that we've ever had. We've had people that have been regularly coming for a while now, and some people that have, just met newfound friends and connections at Welcome Wednesday. So that's at the Beehive pub in Henleaze. So I just wanted to make people aware of it, really. It's a really good resource. It's just very friendly, welcoming place to come along to. So definitely come along to the next one, which is on Wednesday, July the 31st. And it'd be really nice to see you there. So see you then. I went to a later life or a financial planning conference last Wednesday at Ashton Gate, and it was really interesting session on AI. I'm sure you've seen it in the news, some of the developments and some of the opportunities and fears around AI. I'm more fearful of it, really. It was just really scary, the session on AI. There was the speaker was actually, there was a kind of avatar of the speaker on screen, and you could actually ask him questions live. And it was just a bit kind of off-putting, really. But that's kind of where it's going. I think a lot of kind of larger financial firms, national companies will go down this route, and especially on the admin side and on the customer service side. And you're basically kind of inputting answers into a kind of an avatar, and the AI, whatever you want to call it, will answer the questions. And it's just really scary to me that, like, you might not even be dealing with a real person, even though it just kind of brings into question everything that you see, whether it's real or that's probably the way it's going to go, isn't it, over the next kind of 10, 20, 30 years. But I'm just doubling down on our local welcoming face-to-face approach. I just believe that that's the best way to receive guidance, and especially on really important matters like financial planning and pensions, and we talk about today. But just kind of it really help. I say financial matters and health, really, it has to be done on a very personal, individual, face-to-face basis, where you can really understand that person's circumstances. And it's just worrying me, really, that the way it's going, we're going more and more online. And now we're getting to the stage where AI is being unleashed on the world, and you don't really know if you're even dealing with a human being now. And that is just really scary to me. So that was last week at the financial planning conference at Ashton Gate that kind of stood out for me, really. If you are, just before I start on today's talk, if you are watching this on YouTube or any other means, just go on to Harold Stevens IFA and subscribe to our financial planning channel, or like or follow, or however you do it. Or if you're looking at this on Facebook, just follow Harold Stevens. We're very well later life financial planning in general is really well underrepresented really on kind of these kinds of mediums, and we really want to kind of make it more accessible to as many people as we can, particularly in the local area. Obviously, we're in West Bromwich, but kind of northwest Bristol, so that anybody can kind of start picking up on some of these issues and start to get a bit more information about financial planning in later life, because it seems to be a dearth of good, a dearth of good advice really for people in later life. So today, yeah, thanks for joining. So today we are talking about a new study by Russell Investments, which they've put a number of 2.81% per year, which is the value of pension investment advice, which is an extraordinary number really, because that could mean the difference between you retiring or getting a really good retirement income. It might mean the difference between your children or grandchildren inheriting a pension fund for whatever they need the money for in the future. So 2.81% per year as the value of pension investment advice, and that's just the investment advice. That's excluding anything to do with pension planning, you know, around pension advice, higher rate tax relief and contributions advice, you know, from companies, or making extra contributions as a higher rate or additional rate taxpayer. So all the planning around that. It ignores inheritance tax and death benefits planning, which I've gone into great detail in recent, you know, articles and videos about the importance of planning around your death, you know, around your pension. And it ignores all the advice around actual at retirement. So, you know, taking your pension as an annuity or drawing down as a flexible income, cash flow planning. So this study ignores all of that. This is just 2.81% average. Yeah, and this is an average advisor as well. We like to think we're not average. We think we are, you know, leaders in later life financial planning. But the average return, 2.81% per year, which is really kind of shows really the value of pension investment advice. And it's not a great surprise to me. You know, I've been in the industry 20 odd years, and pension seems to have this mythical status really, where no one really wants to or kind of understands it, or doesn't really want to. It's not something that people kind of like to. It's not an exciting thing, is it, on a day-to-day basis to think about your pension? So it doesn't surprise me a great deal. Really, that value is the 2.81% per year is broken down into firstly active management of the investment portfolio, rebalancing your portfolios, and I'll come on to that. The second part I'll talk about is behavioural coaching, you know, investing at the right times, selling at the right times, and having that kind of discipline to think about the long term rather than reacting to short-term, you know, world events. The third thing is like customizing your pension to your actual life and your own retirement goals. So the kind of the planning around that. And fourthly, I'll go into the product alignment, aligning the product that you have, the importance of actually having a product which is aligned to your own circumstances and not go down this one size fits all kind of strategy that you do see a lot of in pensions. So what I'll do is go through those four kind of set elements really to the value, and see what you think really. So first of all, active management. So it's estimated from a recent study that 40% of pension investors don't even know where their pensions are held, even in the first place. They don't know where their pensions are, what providers hold their pensions, which is an obvious risk just to kind of lose track of the pensions that you built up. A third of people don't even know that their pensions are actually invested in the markets. They think it's a kind of a saving scheme. So these quite scary statistics, again, not a particular surprise to me, but it really shows where you could immediately quite quickly add a bit of value to those people's pensions and their retirement circumstances. In addition to that, the vast majority of pension investors they're either in the default pension providers scheme fund. You might be one of those. So you might have I don't know, Standard Life pension that you took out with a company years ago, or an Aviva occupational pension that you took out through your company, or you might have just taken out a personal pension. The vast majority of people are in the default pension fund, which is it's often called, I don't know, the balance managed fund. So there's no alignment or no independence. There's no bespoke advice. You're just in the default fund that the company has kind of given you. And even for people that have kind of chosen funds at outset, they've not done anything for at least 5 years, according to the data. So in general terms, pension investors, either through apathy, through lack of understanding, through just not being interested, aren't taking advice or paying any attention to what investments are actually in their pension, which is the most important thing. The pension is just a wrapper for whatever the investments are within the pension. So it's less important the provider that's kind of providing the technology, the wrapper for the pension. Is more important where you're actually invested. That's the most important thing. So when you hear your friend down the pub say, "Oh, my pension's rubbish," it's not the pension, it's the investments perhaps not being advised or diversified, or have the sufficient quality, or being aligned to that person's own specific circumstances within the pension. That's where the value is. So in terms of things to think about, the first thing to think about is taking independent advice. So in the vast majority of cases, you'll be in whatever fund or whatever provider has been given to you by your company, or whatever you happen to take out, years ago. Many of the national kind of financial planning companies, or bigger companies, or ones that are linked to banks or what have you, will have set providers that they have to basically sell to you. They don't have a choice on where they're going to recommend you go. They'll be targeted perhaps on the amount of pensions that they sell through a specific provider. So it's just something to watch out for, that you're not being railroaded into a specific pension provider. So the first question to ask really is, how independent are you when you're seeking pension investment advice? Or are you independent is the first question. And don't be fobbed off by any kind of answers that might kind of slip around that question. You're either independent or you're not. And then if you feel like you're being railroaded into a specific plan, just ask, do you have other options, or what's the reason why you're recommending this pension plan? It's really important, because you always want the best, or up there with one of the best kind of pension providers and funds that are out there, and you want the ability for your advisor to switch to another one if that's needed in the future. That's really important. And then within the pension wrapper that you've been recommended for various reasons, whether it's strength or track record or quality, you want an independently arranged portfolio within the pension. So you want you want the pension provider or your pension investment advisor to recommend the very best pension funds within that pension wrapper, if you get me. So all the best funds around the world should be available to you. You don't want it to be railroaded into one specific, whether that's a Standard Life pension. I'm picking on Standard Life here. It doesn't have to be Standard Life, but I don't know, Legal and General, managed funds. You want an independent, so you want 30 to 40 funds within your pension, which are independently managed and recommended and chosen and constantly reviewed. And so all of those funds within the pension should have different names. So they should be chosen independently. because you want only the best funds within each sector. So independence is really important. So only really, I would recommend to only really go to an independent financial advisor, an out-and-out independent financial advisor for your pension advice. You don't want to be railroaded into any specific plan that's more in the advisor's interest than yours. Diversification, I've touched on. So you don't want to put all your eggs in one basket. And I'm not talking about having loads of different pension providers, which makes it all difficult to keep track of. One, as long as the pension provider is really strong and it's covered by the Financial Services Compensation Scheme, remember that's the additional security and safety that you get by going through a financial advisor. You get all these kind of insurance safety nets. If you go direct to a kind of a cheap one, or you're trying to save money by going to more what's sold as a cost-effective plan, you may not be covered by some of this kind of insurance, financial services compensation scheme, that kind of thing. As long as the pension provider is strong enough, got financial strength, and is covered by the compensation scheme, it's less about diversifying amongst pension providers. It's more about having within your pension, having a diversified portfolio. So like I said, you want 30 to 40 funds really as a minimum, as part of your pension portfolio. So if you've got 1, 2, or even 5 funds that you've perhaps picked, you're still not diversified enough. You don't want to put your whole retirement strategy and plan. You don't want to rely on only 1, 2, 3 funds, and they're all funds of the same make. They're all trying to think of a different Aviva funds. You want them all spread out across lots of different. You want 30 to 40 funds of all different qualities, of all different sizes and investment styles around the world, and you want that reviewed ongoing. So you want active management. So if one fund changes its fund manager, you take that one out and you put one in its place, which is now the recommended fund. So this is active management. When you consider that, people aren't looking at their pension funds, or they're in the default fund for years and years and years, you can quite quickly see how the value of the advice would build up, by reviewing these pension funds investments on an ongoing basis and aligning them, according to world circumstances and the quality of the funds. The funds need to be aligned to your own what's called attitude to risk. So the attitude to risk is what your tolerance levels are to the short-term ups and downs in the investments. So your investments in the short term will go up and down according to what's happening in the economy and in the markets around the world. And so you need to be comfortable that in the short term, investments will go up and down. And with the knowledge that in the long term, there's always been a kind of long-term growth in investment portfolios. That's just fact that they always go up in the long term, but it's how tolerant you are in the short term to that. And so you need to be comfortable, with the level of investment risk that you're taking. If you take the highest investment risk, which is absolutely fine, which basically means you're in the stock market, which is really good. That probably means that you'll get the best possible return over the longer term. But it does mean that you'll get some short-term ups and downs, more pronounced ups and downs, depending on what's happening on a day-to-day basis. Whereas you may not be comfortable with short-term, dips, and that's absolutely fine if it's just outside your comfort level. We need to discuss what your comfort levels are, and then we can introduce different asset classes which can buffer the short-term swings in the stock market, cash, fixed interest, bonds, government gilts, property, things like that into your pension, just to give you that buffer, so that you don't feel uncomfortable really with the investment ride. So that all needs to be aligned to your own, circumstances and your own tolerance levels to investment risk. And I'll come on to kind of emotional behavior of investing, but that'll stop you making wrong decisions at the wrong times because you're within your comfort levels in terms of the investment day-to-day investment returns on your pension. So really important to just get your investments within the pension in line with your comfort levels and be continually guided on that going forward to make sure that that's also aligned to your stage of life, which I'll come on to in terms of aligning to your stage of life and your own specific retirement goals. You want quality, so you want investment funds within your pension portfolio that are shown. I mean, we go with a minimum of a 5-year track record of investment funds, but you want that kind of long-term history of performance and quality. I would strongly be wary of any adverts which say this is the next big thing, or this is the next best fund, or kind of new funds which are showing perhaps good performance in the short term. And there might be a million reasons for that, but they might have taken a gamble on something and it's come off. Or so you want kind of longer term track records. You want slow and steady. You want quality and proven quality over time. And you want that quality to be reviewed ongoing because things do change, and you do get you can quite quickly lose track of what your funds are and how they're performing over time if you're doing it yourself. I'm not to say you can't, but you do have to have a really strong interest in investment portfolios and investment funds and have a good understanding of the stock market. In my opinion, basically to do it yourself, you need to be looking at it regularly to keep on top of things, because things do change, unfortunately, in the stock markets. And just rebalancing and being active according to world events. So, you think, I mean, our recommended portfolios are now 10 years on. So when you think, what's happened in the last 10 years, we've had Brexit, we've had America and China having trade wars, we've had the pandemic, we've had lockdowns and all the kind of the repercussions of the world basically closing down. We've had elections around the world. We've had war in Europe. We've had an incredible 10 years, really, of a string of world events over the last 10 years. Yeah, our medium risk portfolio has achieved 84% return over the last 10 years. And that's the medium risk. If you were willing to take the highest investment risk and invest just in the stock market, you'd return almost double that, 160% return over the last 10 years. It's just the power of long-term investing. You need to stay invested. You need to stay the course. And it's perfect with pensions because pensions are by their nature long-term. Usually you are investing for your retirement, you're tied into your pension for your retirement, so you're investing long-term. There's no other choice for young people in a pension. You can only take your pension in your mid-50s. But also people in retirement, it's long-term. The chances are that if you're watching this in Westbury or Henleaze or Northwest Bristol, the chances are, that you're going to live into your 90s now, maybe even into your hundreds. And the chances are that pension fund might be a vehicle for inheritance tax planning or a trust fund for your children and grandchildren. So it might be that you're looking 40, 50, 60, 70 years might be the time frame that you're looking at for your pension investments. So I think we need to start thinking more longer term and not reacting to this short-termism, which is just the day-to-day news, and everything is fearful, isn't it? Everything's day-to-day. Now it's all what's going to happen with the election in the UK coming up in a couple of days. We need to think longer term, with our pension investments. So that's active management. The second, got a frog in my throat here. Excuse me. The second part of where an advisor can add value to your pension investments is behavioural coaching. Investing can be a wild ride. Like I've just said, over the last 10 years, we've had all sorts of things happen. We've had big swings in the stock markets, and it can be like a roller coaster ride for pension investors. And this is really, really difficult if you are going it alone, trying to do things yourself. The pandemic, 2020, perfect example of this. So at the outbreak of lockdown, in the start of the pandemic in 2020, the FTSE All Share lost, this isn't just any funds, but just the FTSE, the index lost 35.9%. So a dramatic fall in the index on the onset of lockdown, because basically the economy was slowing down, well, closing down, not slowing down, closing down. For the people that simply stayed invested, so if you were invested in the FTSE All Share, simply by staying invested, you would have rebounded 27.8% just within 3 months. So within 3 months, you virtually would have recovered all your losses. And within a year, you would have completely recovered, and you'd actually been in a slight profit after a year. But all of the data shows that people just don't do that. They don't stay the course. So, you've got I think the data is that you've got a 4 times more chance to stay invested if you're with an advisor than if you're doing it yourself. And I do completely understand, because it can be really scary, especially something like the pandemic hitting. Your pensions are getting absolutely, crucified, and it's just the emotional side of things just makes you want to do something. And people do unfortunately sell at the wrong time. So it really comes down to buying low, selling high, but it's a really difficult thing to do when you are being bombarded with bad news, you're being bombarded with horrible numbers, and you're just fearful that your retirement is going down the toilet because, that's just what's happening. So the actual figures are that for unadvised investors, they sold £2.2 billion from UK equities from May 2020 to January 2021 at that wrong time. And the net inflow of investing back into the UK market only happened in February 2021, once the markets had completely recovered again. So that's just a perfect example of people selling at the wrong time when investments and markets are down through fear, and then buying back up, when the markets investments have recovered, and so you're buying in effectively at a high again. So if you don't remember anything else, just remember, buy low, sell high. So when everyone is fearful, that's when you want to be greedy. If everyone else is being greedy, that's when you want to be fearful. So, it's just, and that is just the value of having an advisor. The advisor will give you the objectivity. They'll be able to bring you back to the long-term plan. They will be able to reassure you about what's happening. I remember the pandemic. I spent 2 months at the start of that lockdown phoning every single client, making sure and reassuring them and taking them through what we felt was happening. And I think out of hundreds of people that I must have phoned, I think only one actually sold some of their portfolio, and that really was just, they wanted a feeling that they were doing something about it. So that was 1 out of hundreds. And as I say, you've got 4 times more chance of staying invested if you're with an advisor. So it's food for thought. We can't predict, what might happen, in the future. Nobody can, but it's just the power of long-term investing, really, and having that kind of long-term approach. Generally speaking, the markets are up 3 out of every 4 years. So if you kind of remember that, so in a down year, just remember that's normal when you're investing to go down once every 4 years. So if you happen to invest in that year, you're unlucky. But generally speaking, 3 out of 4 years is a positive. And if you invest for 10 years, you've always made money over 10 years if you invest over that period. So that's always going to be a big part of advisor coaching, and that adds a huge value to your pension over the longer term. The next one thing I wanted to talk about was customizing your pension advice to your own specific circumstances. So each individual person have their own unique goals, their own unique circumstances, their own unique family, their own preferences. You know, they might have ethical preferences, or they might have different needs and wants about how they want their pension to be invested. But the bottom line is people have different retirement goals. There's no, I think gone are the days really of, people are retiring on a specific day. The general trend really now is to kind of retire gradually and maybe take some part-time work, do charity work. And ever since Flexi Access Pension came in, there's no need now to take an annuity. You can kind of draw down on your pension over time. And so the pension has to fit in with your own specific financial plan. Pension's only part of your retirement. People think of your pension as your retirement, but you'll have ISAs, you'll have investments, you'll have tax planning, you'll have intergenerational planning, where you want to make sure your pension transfers to your next of kin completely tax-free of inheritance tax and everything. So you want to make sure your death benefits are aligned to your wills, and your power of attorneys are set up so to make sure that your pension advice continues even if you don't have the capacity to make decisions. So it's really important that your pension is aligned specifically to your own individual circumstances and goals, and have that advice delivered on a very face-to-face, relaxed style, where you can take your time and make these decisions in an unpressurized environment. In this day and age, with a click of the button, you could make changes which could affect your whole retirement. So we would like to kind of deliberate slowly over these decisions, face to face, over a cup of tea and a piece of cake, even, just to kind of at a time where you're relaxed and you feel that you can make informed decisions, and no knee-jerk reactions. Like we just talked about all the things that can happen in the world, and being bombarded by news. You want to reflect and talk and really think about any decisions, and bring the family into these decisions as well, and have everything aligned to your own specific goals, which aren't financial. You'll have your own life goals for your retirement and beyond. We want that pension really to help you achieve those goals, rather than the other way around. So again, in a lot of cases, you'll have a one-size-fits-all strategy. You'll either have a pension that you took out 30 years ago through the company and nothing's changed since, or you'll have an advisor that sold you a pension plan years ago, and again, nothing's changed since, and it's nothing to do with or not aligned to your own specific goals. So it's really important that you get your own specific client experience, and so that's really important. And probably just kind of on from that, the final piece really is that you want the product to be personalized for you. So a bit kind of along the same lines of independence and attitude to risk, and ensuring that the product itself is exactly aligned to what your goals are and what's important for you. So an example might be, you might have ethical leanings, so you might be interested in sustainability and investing for good in the local, either whether in the UK or worldwide. You might have environmental type preferences. So if that's the case, we can kind of guide you down that route and look at potential solutions for that. You might be coming up to retirement and looking for a retirement income strategy, partly a guaranteed one, partly kind of investing for the long term. So you might want to guarantee to cover some, fixed costs that you have, but you might have parts of your portfolio that can grow over time. You might not ever want to touch your pension, and it's an absolute trust fund for the children. So you want to make sure that your pension is set up in a way that it's going to transfer tax-free to your beneficiaries, and that might be important for you. So again, a bit along the lines of the previous previous point, each of your pensions needs to be absolutely aligned as part of your overall strategy. It's not just a pension on its own, let's hope for the best. At the end of the day, it's all part of your life, and to make sure that your own life goals are achieved. That's what a pension's for in the end. So that's really where a lot of the value is covered off. So 2.8% per year is the average return that's been calculated for an advised pension. And that's the average. You know, we are later life financial planning specialists. I'm sure you've seen us in Westbury. You know, we're completely independent. We're happy to see you. We can take on new clients if you feel that you want pensions advice. We'll give us a call, send us an email, or give us a call in the office, and we can arrange an initial complimentary meeting where we can explore those circumstances. This is what it's all about. We would spend time with you to explore your own personal preferences and goals and life and family and attitude to risk and all of those things that are important to you. That's what we'll listen to you in our living room style office. We'll listen to you, and then only then we'll decide together whether advice is required, and whether that's pension advice or whether we need to bring all aspects of our services into it. So the first meeting is completely complimentary anyway, so you've got nothing to lose. As I said, it's a chronically under-advised area, pensions. So I would definitely at least seek advice from your existing advisor, or come in and see us, and just to see whether you can be helped really with your own goals. I hope that's been helpful as part of our pension series. Don't forget the Later Life Summer Fair coming up on the 19th. If you go to Harold Stevens' website on the events page, and that's www.haroldstevens.co.uk. If you go onto the website, on the events page, you'll get information on not only events that we're doing, but also local community events that we're doing as part of the Later Life Alliance that we do. So you'll get the details about the Later Life fair there. If you want to volunteer for it, that's even better. Or if you want a stall, that's even better. Or if you've got entertainment, or if you've got any ideas that you want to bring to it. But if not, just come along, see what we have on offer. Welcome Wednesday is another one that you'll see there on the events page. And don't forget Harold Stevens IFA on YouTube, just to kind of build up that later life community, because the more people engage in that, the more people will get to see this information, and it will get people to trigger in their minds that, you know, these sorts of things need to be talked about in order for people to help them with their financial goals. So thanks again. Thanks for joining, and we will see you next time. Okay, cheers. Thank you. Bye. Bye.